Welcome back. In this lesson, we shall be introduced to the various classes of investment assets and contracts and learn how financial markets can be classified. Let's dive right in. Some of the most commonly traded assets include securities, which generally include debt instruments, equities, and shares in pooled investment vehicles. Currencies, which are monies issued by national monetary authorities. Commodities, like precious metals, energy products, industrial metals, and agricultural products. Real assets, which include real estate and other physical assets of value like airplanes or machinery. Let's have a quick introduction to each of them. Securities can be classified as fixed income or equity securities. Fixed income securities typically refer to debt securities that promise to repay the borrowed money in the future. They can be distinguished as short-term, intermediate-term, and long-term fixed income securities. However, there is no general consensus on their definition. Instruments that mature in less than 2 years can be considered short-term, whereas those that mature in more than 10 years are considered long-term. In the middle are intermediate-term instruments. But, as mentioned, the lines between them are kind of fuzzy. And the fuzziness doesn't stop there. Bonds are generally long-term and notes are generally intermediate-term, but it's not rare to find securities that don't follow these definitions. Short-term debt issued by firms is known as commercial paper, and short-term government debt is sometimes called bills. Another form of short-term debt comes in the form of repurchase agreements or repos. The borrower sells a high-quality asset to the lender and has both the right and obligation to repurchase it at a higher price in the future. Repos can be for terms as short as 1 day. Convertible debt are debt instruments that have the option to be exchanged for a specified number of equity shares of the issuing firm. Regardless of the type, fixed income securities typically have a fixed maturity date where the principal is repaid and interest is paid out periodically before maturity. All these securities are covered in detail in the fixed income course, so what we've described here is just a brief summary. Equity securities represent ownership in a firm and include preferred stock, common stock, and warrants. Preferred stock is an equity security that pays regular dividends that is typically fixed over the security's life. This, however, does not place preferred stock in the same class as bonds, as there is no maturity date, and the dividends can only be paid after interest payments to debt holders have been fulfilled. Common stock is a residual claim on a firm's assets. Common stock dividends are paid only after dividends are paid to preferred stockholders. Therefore, dividend payouts are not fixed and are entirely at the discretion of the management. Warrants are similar to options in that they give the holder the right to buy a firm's common stock at the stated exercise price prior to the warrant's expiration. Warrants are considered equity because they are issued by the company and can potentially become equity if the holder exercises the right to purchase. In the event of firm liquidation, the priority for payouts also applies in this situation. Debt holders have priority over preferred stockholders, who in turn have priority over common stockholders. Individual securities can be combined into pooled investment vehicles. The term refers to structures that combine the funds of many investors to build up a portfolio of investments. Such pooled investment vehicles can be mutual funds, exchange-traded funds, asset-backed securities, or hedge funds. The investor's ownership interests can be referred to as shares, units, depository receipts, or limited partnership interests. Mutual funds can be open-ended or closed-ended. Open-ended funds issue new shares when an investor buys in and redeem existing shares when an investor sells, usually on a daily basis. The price at which a fund redeems and sells the shares is based on the net asset value of the fund's portfolio expressed on a per-share basis. Investors generally buy and sell open-ended mutual funds by trading with the mutual fund. In contrast, closed-ended funds issue shares in primary market offerings. Once issued, investors cannot sell their shares of the fund back to the fund by demanding redemption. Instead, they must sell their shares to other investors in the secondary market. The secondary market prices may differ from their net asset values, usually at a discount. Exchange-traded funds also trade like closed-end funds, in which investors trade their shares in the secondary market. Unlike closed-end mutual funds, their market price is actually quite close to the net asset value of the portfolio. This is because ETFs have special provisions allowing some authorized participants to convert their shares into individual portfolio securities when the price is significantly below NAV, or exchange of portfolio shares for ETF shares when the price is significantly above NAV. Such activities help to keep the market price of the ETF close to the NAV per share of the portfolio. ETFs are sometimes referred to as depositories, with their shares referred to as depository receipts. You can learn more about mutual funds and ETFs in the portfolio management topic area of the CFA curriculum. Asset-backed securities are securities whose values and income payments are derived from a pool of assets, such as mortgages, credit card debt, or car loans. The interest and principal repayments on these loans are passed through to investors with different classes of claims and levels of risk based on the seniority of the security held by the investor. Asset-backed securities are covered in detail in the fixed income course. Hedge funds are organized as limited partnerships, with the investors as the limited partners and the fund manager as the general partner. The limited partners are qualified investors who are wealthy enough and well-informed enough to tolerate and accept substantial losses should they occur. Hedge fund managers typically charge a management fee based on the amount of assets under management, as well as an incentive fee based on their investment results. They try to add value by utilizing various strategies, and leverage is often used to amplify the gains. Now, an asset that we're very familiar with. Currencies are monies issued by national monetary authorities. Approximately 175 currencies are currently in use throughout the world. Some of these currencies are regarded as reserve currencies, which are currencies that national central banks and other monetary authorities hold in significant quantities for international trade and as a foreign reserve. The primary reserve currencies are the US dollar and the euro. Secondary reserve currencies include the British pound, the Japanese yen, and the Swiss franc. Currencies trade in foreign exchange markets. In spot currency transactions, one currency is immediately exchanged for another. The rate of exchange is called the spot exchange rate. Now, exchange of currencies does not need to be transacted immediately. Two parties can agree on a fixed rate to exchange at on a date in the future. This can be arranged by means of a contract, which we will skip ahead to for now to explain financial contracts. Contracts are generally agreements between two parties to perform some action in the future. For financial contracts, these actions are often based on security prices, currency exchange rates, commodity prices, or security indexes. We shall have a quick overview on forwards, futures, swaps, options, and insurance contracts. These are commonly known as derivatives and are covered in detail in the course on derivatives. A forward contract is an agreement to buy or sell an asset in the future at a price specified in the contract at its inception. For example, Green agrees to buy from Red 85 ounces of gold 95 days from now for $1,212 per ounce, and Red agrees to sell at these terms. On the settlement date, which is 95 days from now, the terms of this contract must be fulfilled by both parties. Forward contracts are initiated and traded in over-the-counter markets, where the parties customize the terms of the contract according to their needs. Futures contracts are similar to forward contracts, except that they are standardized contracts traded in a central exchange. This makes futures contracts more liquid than forward contracts. So, using the same example, a standard gold futures contract may specify the delivery of 100 ounces of gold 90 days from initiation at $1,212 per ounce. So green can take the long position of one contract and red can take the short position of one contract. Futures contracts may not meet the exact needs of the participants, but their liquidity and ease of trading makes them an attractive instrument for parties that want to hedge against changes in prices. In a swap contract, two parties agree to pay each other, such that the net payment is equivalent to one asset being swapped for another, usually over multiple settlement dates until the expiry. In a simple interest rate swap, floating rate interest payments are exchanged for fixed rate payments. A currency swap involves a loan in one currency for the loan of another currency for a period of time. An equity swap involves the exchange of the return on an equity index or portfolio for the interest payment on a debt instrument. An option contract gives its owner or the long the right to buy or sell an asset at a specific exercise price at some specified date in the future. The long pays the short a premium to initiate an options contract. A call option gives the long the right to buy, while a put option gives the owner the right to sell. Unlike forwards, futures and swaps, where the long is obliged to transact, options give the long the right, but not the obligation to transact. If the long exercises the right, the short, who is the writer of the option, has the obligation to sell or buy the asset according to the terms of the contract. You should be quite familiar with insurance contracts. Basically, you pay a premium to the insurer to hedge against the risk of an unfavourable event that may occur in the future before an expiration date. If the event occurs before the contract expiration, you receive a cash payout that compensates you for the financial loss due to the event. Common insurance contracts include life, liability, and automobile insurance. Some insurance contracts can be traded to other parties. One such example is a credit default swap. A credit default swap makes a payment if an issuer defaults on its bonds. They can be used by bond investors to hedge default risk. They can also be used by parties that will experience losses if the bond defaults. Credit default swaps also attract interest from speculators who want to bet on the probability of an issuer defaulting on its bonds. And with an understanding of financial contracts, let's head back to where we left off in our discussion on investment assets. Commodities include energy products, industrial metals, precious metals, agricultural products, and carbon credits. Spot commodity markets trade commodities for immediate delivery, whereas the forward and futures markets trade commodities for future delivery. The producers and processors of commodity products are the primary users of the spot commodity markets, as they are best able to take or make immediate deliveries. Many producers employ financial analysts to help them analyze commodity market conditions so that they can best manage their inventories to hedge their operational risks and to speculate on future price changes. Besides, many of the producers and consumers of commodities take opposite sides in futures and forward contracts to hedge against change in price in the future. For example, an airline may take the long position in a forward contract with an oil producer as the short. Both the airline and the oil producer are assured of the price they can buy or sell the oil at in the future. Besides producers and consumers who are operationally exposed to the risk of changing commodity prices, some traders and investment managers also have an interest because they can speculate on future price change or use commodities as hedges against risks in their portfolios. They prefer to trade in futures markets as they are trading in a central exchange which provides more liquidity than their associated spot markets and forward markets. Commodity investments are covered in detail in the course on alternative investments. And lastly, we have real assets for investments. Common examples of real assets are real estate, equipment, and infrastructure. Although they have been traditionally held by firms for their use in day-to-day operations, real assets are increasingly held by institutional investors. Institutional investors can invest in real assets directly or indirectly through an investment vehicle. Direct investments often provide direct income, tax advantages, and diversification benefits. However, they often entail substantial management costs. Furthermore, because of their heterogeneity, they usually require the investor to do substantial due diligence before investing. They're also illiquid, as the investment size can be large and the pool of investors is limited. Indirect investments can be through vehicles such as real estate investment trust, master limited partnership, or stock of firms that have large ownership of real assets. The investor owns an interest in these vehicles, which hold the assets directly. Indirect ownership interests are typically more liquid than ownership of the assets themselves. So we've discussed the four main classes of investment assets, plus financial contracts, which are a form of asset as they derive value from the underlying assets. All these assets trade in markets, which can be classified in a number of ways. One way is to classify by whether the markets trade instruments for immediate delivery or for future delivery. Markets for immediate delivery are referred to as spot markets, while those that trade contracts for future delivery are forward or futures markets. Options markets trade contracts that deliver in the future, but delivery takes place only if the holders of the options choose to exercise them. Another way to classify markets is based on the source. This applies more to securities like stocks and bonds. When issuers, which are mainly government or corporate entities, sell new securities to investors, this is known as the primary market. Subsequent sales of securities are said to occur in the secondary market. In the primary market, funds flow to the issuer of the security from the purchaser. In the secondary market, funds flow between traders. Markets can also be classified by maturity. Money markets refer to markets for debt securities with maturities of 1 year or less. The most common such instruments are securities such as repurchase agreements, negotiable certificates of deposit, government bills, and commercial paper. All these are debt securities and are covered in the fixed income course. In contrast, capital markets refer to markets for longer-term debt securities and equity securities that have no specific maturity date. And lastly, markets can be distinguished between traditional investment markets and alternative investment markets. Traditional investments include all publicly traded debts and equities, and shares in pooled investment vehicles that hold publicly traded debts and/or equities, like an equity index ETF. Alternative investments include hedge funds, private equities, commodities, real estate and infrastructure investments. Because these investments are often hard to trade and hard to value, they often sell at a discount and require substantial investor due diligence. All these instruments are discussed in detail in the course on alternative investments. And that concludes this lesson, where we were introduced to the various investment assets and markets. Almost all of the types of securities discussed are covered in detail elsewhere in the curriculum, so don't worry if these are terms you're not yet familiar with. Up next, we shall be introduced to financial intermediaries like brokers that help market participants achieve their goals. See you at the next lesson.